You're listening to the Maple Tree Capital podcast, where we put retail first, institutions second. Please note that all opinions shared today are that only of Maple Tree Capital and no other party. Please do proper due diligence and seek proper financial counsel before making an investment decision. Nothing presented today is investment advice. You are listening to the Maple Tree Capital podcast. I'm your host, Henry Invests on X, founder of Maple Tree Capital. It's time for In the Treehouse, where we talk about the portfolio moves we've made at Maple Tree Capital in our Heartwood and Jonagold portfolio. Remember, retail possesses distinct advantages over Wall Street, particularly in terms of time and conviction. Jonagold strategically leverages these attributes, focusing on companies with substantial growth prospects that are A, temporarily out of favor due to cyclical trends, B, significantly misunderstood, or C, a combination of both. That's a little bit about our philosophy for the Jonagold portfolio, which is really our growth-centric portfolio, where a lot of the names that I talk about on X at Henry Invest, like Upstart, Lemonade, those are in the Jonagold portfolio. A lot of disruption. So this week, we really did not make many moves in the portfolio. It's a rising market, we all know that. So a lot of our strategy is to mitigate the risk of these concentrated holdings by using option strategies. Now, to eliminate the risk, that means really hedge in case they go down. And this last week, a lot of stuff did not go down, right? So there wasn't a lot of hedging going on. On Friday, we did sell some 0 DTE calls on Upstart and HIMS, which ended up working out. Those expired worthless, so we got a little bit of covered call income there. Nothing too crazy, but I do just want to say, for those who are maybe earlier in their investment journey, when you start to build large positions in terms of share count, right, because to sell an option, you have to have 100 shares of a stock. When you really start to build large positions, the opportunities to generate meaningful yet somewhat small amounts of money are endless. And what do I mean by that? Well, if I said, hey, there's $25 on the ground, are you going to pick it up? Most people, I think, are going to pick that up. Now, who knows? It may take you $50,000, $60,000 to generate an opportunity that is so, juicy, if you will, that you think, hey, I can really make this $25 with almost no risk. Well, yeah, I'm going to take that chance, right? And so that's a lot of the strategy that we've been doing on Fridays, depending on what the market is, right? So collateralizing a large Upstart position, in exchange selling calls that really have no chance of hitting, and if they did hit, we would be comfortable selling at that position given that move. So that's something to think about, especially for growth stocks. If you have very large positions, you can sell options that are already basically worthless for a little bit of premium to, I don't want to say gamblers, but people that are heavily speculating on where the price is going to go. Now, if you do that 100 times, I think you'll probably win 99 and you'll lose 1. So you have to be very careful with how you do it, when you do it, what the market environment you're in is, when you're doing it. So there's a lot of extra things that go in behind the scenes. Selling covered calls is not just easy money. There's a very large chance that you get your shares called away. So it's okay, well, what's the theta decay going to be? Looking at the time, how much time is left to expiration? What's the strike price? Okay, let's chart the stock a little bit. Like, for example, for Upstart, 72 is a huge level of resistance. So that's right there. That's a piece of knowledge that I have looking at that chart than somebody who hasn't even looked at the chart and wants to sell a call, right? So little things like that. Do your homework, prepare. Don't want to go in unprepared, certainly. But there are, and I've been noticing, there are some opportunities to sell and generate a little bit of covered call income with very short expirations on some high-flying names. And so just keep that in the back of your mind as you go through your portfolio. Okay, so that's really what we did with Jonagold this week. We talked about how we sold Oscar last week, which was good. The price of that actually came down to about $19 after we sold it. We sold it at a little over 20, so that's a really good move for us there, and we reinvested those profits into what we'll talk about shortly. But Oscar, as it sits on Friday, closed at $20.41, right around where we sold our shares. So happy with that trade. And now Jonagold holds only 4 positions: Grindr, HIMS, Lemonade, and Upstart. We're very happy with all of those. Okay, so moving on to our Heartwood portfolio, this has had a absolute killer week. I mean, this portfolio has just been on a tear. We're coming up on some easy comps with some lackluster performance that we've touched on. Krispy Kreme, certainly somebody to blame for that, but we've touched on that. We'll touch on that a little bit more. But really, truly a phenomenal week for this portfolio. So, as a brief reminder, Heartwood is a high conviction portfolio focused on misunderstood companies with the potential for operating leverage, brand reinventation, and long-term relevance. We seek out overlooked businesses that are either underestimated by the broader market due to cyclical headwinds or unconventional strategies, as well as a lack of immediate profitability. So I'll go ahead and I'll read you the names that we have here, and you can come to your own conclusion, I guess, immediately on if you think they're any good. Academy Sports and Outdoors, CrowdStrike, Electronic Arts, Lyft. Very interesting one on Lyft. Might do a special episode deep dive on that. NBIS, Reddit, Shark Ninja, and UEC, Uranium Energy Corporation. So that's what's in the Heartwood portfolio right now. Been on a tear this week. We took the proceeds that we got from the Oscar sale in Jonagold, actually moved that over to Heartwood and bought Shark Ninja with that. Shark Ninja was last week's stock of the week. And I just thought it was a very compelling opportunity at around $90 a share, given the long-term brand relevance, the durability of the product, the fair price point of the product, everything that the consumer wants in this economy. Durability, stability, price stability, right? Reasonable price, good quality product. Like, that is everything that Shark Ninja's brand is built around. Couple that with the fact that they're a little bit more immune to tariffs than the general market may think, because they prepared for this during Trump's first term, and also a hot stock coming off a really well-received IPO, and I think you got a recipe for success. So we have shares at about $90. Those are up a little over 6%. Very happy with that, and I think we'll be continuing to add that stock until it gets probably to around $110. But Uranium Energy Corporation also had a very nice week. We're starting to see really what our thesis has been play out, which is that to power all of these AI needs, you're gonna need more data centers. And while coal can power a lot of that, it's time to start looking at alternative solutions such as nuclear, and uranium is the number one ingredient, if you will, in nuclear. So really, CrowdStrike too. I mean, cyber is starting to take off. Cybersecurity has always been a name that's traded really rich, but I think that's for good reason. If you think about the TAM of where that is going, it almost seems endless. Cybersecurity is something that every business, every consumer, every person needs. And CrowdStrike, we bought during the big global outage fear, which a little bit of luck, but we're up 91% on those shares, and that's sort of ballooned into the fund's largest position there. So very happy with how that's gone, but we did not make any other trades in the portfolio this week other than buying Shark Ninja. As we look into next week, right, with the market being at all-time highs, I'm not entirely sure what exactly is going to happen. We are not going to be net buyers over the next week. I will say that. I think if anything, may look to trim some tops or sell some calls. Who knows? We have to see them. We have to trade the market that is in front of us. It's feeling a little hot. It's feeling a little speculative. And so just going to want to capitalize on that and make as much money as possible. Obviously. The last thing I'll say on that, I talked a little bit about it earlier in the Jonagold portfolio, with being able to sell far out the money, short expiration, high theta decay calls, is that those opportunities tend to appear more in markets that are really starting to run hot. And I noticed that this week, noticed it a little bit last week, that the options premiums were getting juiced on a lot of those situations. So we'll see if it continues into next week. If it does, we'll certainly try and take advantage of it. But overall, I think the market's running a little bit hot. There's rationale for that. There are some risks, but earnings are going to be the big deal, and earnings are coming up soon for the general market and the companies that we hold as well, and we'll have to see how it goes from there. But a large reason that the market has shrugged off these tariff and uncertainty fears is because corporate earnings were so good last quarter, and guidance was good as well. For most companies, select few disappointed. But you have been listening to the Maple Tree Capital podcast, and that is what's in the treehouse. It is time for the Macro Pulse. Last week, we talked about the Federal Reserve's FOMC meeting and how the committee left rates unchanged at 4.25% to 4.5%. Jerome Powell and the Fed continue to face extreme pressure from the general public to cut rates, and President Trump continues to lay on the gas. While speaking with reporters in the Oval Office on Friday, President Trump had this to say of Jerome Powell. Quote, "He's a stupid person, a stubborn mule. I've instructed my people not to do any debt beyond 9 months or so. Get this guy out. If I think somebody's going to keep the rates where they are or whatever, I'm not going to put them in. I'm going to put somebody in that wants to cut rates. There are a lot of them out there," end quote. And so a few obvious things here. First, this is really no way to talk to the chairman of the Federal Reserve. It's incredibly disrespectful. And the Fed is an apolitical government body that is supposed to act independently of political pressure. And it seems just because that pressure may not be aligned with what President Trump wants to do, or their stance may not be aligned with Trump, that he thinks it's okay to just totally trash and disrespect them, which I think is not a great look for the highest leader of the United States. But it seems like Trump, too, has also forgotten that, number one, he appointed Chair Powell. Number two, the decision to leave interest rates unchanged was a committee decision, not just something that Powell decided to do. And three, I personally totally believe Trump when he says he is going to put in a Fed chair that will cut rates. This is a little scary because what I just said, right? The Fed's job is to be apolitical and to do what they independently assess is best. But we have to react to the market in front of us, and Trump is screaming that rate cuts are coming, quite literally, which is very good for risk assets. So while, yes, it does seem like the Fed is behind the curve in cutting rates, we've seen the central banks all across the world drop their benchmark rates. If you ask yourself the why behind that, it's really because of President Trump's tariffs and the uncertainty that they've created. You know, prior to Liberation Day, the Fed was set to continue to drop rates into easing inflation pressures. And the July 9th 90-day tariff pause deadline is coming up, and I suspect President Trump may extend this. On Friday, Trump really echoed this, saying, you know, quote, "We can extend it or we can shorten it," end quote. This is Trump speak for Taco. Trump always chickens out. It is in Trump's best interest to push back these tariffs because that will push back any inflation shocks, which will force the Federal Reserve's hand to cut rates. Just like how Liberation Day was one big game of global chicken between the U.S. and China, we're really setting up for round two here in the cage with Trump facing off against the Fed. The Personal Consumption Expenditures Report, PCE, came out on Friday. PCE measures the average change in prices for goods and services consumed by households in the U.S. It's the Federal Reserve's preferred gauge of inflation because it captures a broad range of spending and adjusts for changes in consumer behavior. PCE is important because it helps guide monetary policy decisions, especially interest rate changes aimed at maintaining price stability. Core PCE rose 0.2% month over month, higher than the 0.1% expectation. Personal income came at negative 0.4% month over month, much lower than the 0.3% rise expected, and personal spending came down 0.1% month over month versus expectations of a 0.1% increase. This paints a broader economic picture of slightly persistent inflationary pressures despite weakening consumer fundamentals, suggesting that while prices remain somewhat sticky, slowing income and spending may signal a growing strain on households and a potential slowdown in economic momentum. The economy does appear to be at a pivotal turning point. If you didn't have any fears of reigniting inflation from tariffs, it would almost seem certainly appropriate to cut rates in this scenario, as the federal funds rate is much higher than CPI. Despite this, markets are having a great week and have reached almost all-time highs, in some cases all-time highs, with the exception of small caps, really fueled by geopolitical tensions, trade progress, as well as rate cuts and AI optimism. That's it for today's Macro Pulse. It's time for Stock of the Week. This week, we're going to be talking about Grindr, ticker GRND, a very interesting play that I've been covering a little bit online under the Henry Invest brand and that we own at Maple Tree Capital, but one that still remains very underfollowed and has recently experienced about a 10, 15 or so percent pullback in the share price, which could be an opportunity. So full disclosure, we own Grindr shares at a little over $10 a share, so we're up. We've doubled our money on that since we really bought the stock in early 2024. And I think it gets a lot of misconception as just a gay dating app, which, yes, that is a very large portion of what they do, but sort of the statistics around the community and what they're looking for offer a different picture, and I'd like to share that with you today. So Grindr, yes, they're a gay dating app, meaning they facilitate connections between gay, bisexual men and women. And the first thing you have to understand about that, and I think people just maybe try to ignore it because it's uncomfortable to talk about, is that gay men and women have stronger sex drives than straight people, meaning they're more likely to connect for casual hookups, which is good for Grindr's business because it facilitates more user activity and more user traction. And so what we've seen is that Grindr users spend over an hour a day on the app. That is unbelievable. Just think, if you're listening to this as a heterosexual male or female, would you spend an hour a day, for the course of a year on that app? I think you'd be hard pressed to find somebody who would. So it's a very sticky product, right? And it's a community that's very niche, which means the monetization opportunities are almost endless. And so what Grindr's done is they took a very underfunded, underappreciated business, and they brought it with new leadership. They brought it public via SPAC, which also put a big damper on the share price. And now they're turning it around by leveraging the brand to its full extent. So more people, like I said, an hour a day. That's more than Instagram, I believe. And what they're doing now is they're making it more than just a gay dating app. So let's look at the core user demographic, right? Gay men and women. Well, gay men and women tend to make more money than heterosexual men and women. They tend to have higher incomes. They tend to travel more. Once again, they tend to spend more time on apps. And so that demographic already is a very powerful customer base. Now, you may be saying, well, yes, it's powerful, but it's very niche. And yes, it is niche, but we're just talking the United States right now. There are countless countries in the world where it's still even illegal to be gay. So there are a lot of tailwinds politically as acceptance starts to grow a little bit more. But, let's say that doesn't happen. Well, you still have a very strong, engaged niche user base. So the question then becomes, well, how can you monetize them? Because monetization is what's really important. And so a traditional dating app, like Bumble or Tinder, what they're going to do is they're just going to sell you a subscription to say, hey, we'll match you with more people, we'll give you more likes, and then, you can go from there. But Grindr takes it much, much further. They're rolling out new product offerings by leveraging AI to deliver a superior customer experience that transitions Grindr into being just a dating app into more of a social networking community for the LGBTQ. While they're doing this, they're still investing in the free user experience and upgrading that as well. At the same time, they have EBITDA margins of over 30%, they're free cash flow positive, and now that they've extinguished some warrants, they're going to be net income or net positive for the coming years as well. So this is a business that's growing profitably, and at the same time, since they're able to invest so cheaply in their business, there's a lot of excess capital that they're returning to shareholders in the forms of buybacks, and soon to come, maybe, according to management, dividends. This is a very shareholder-friendly company that the CapEx to fuel the growth is not that high. The user base is highly engaged. The mission is socially important. And we've seen tangible results of their strategy working. Grindr's ARPU, average revenue per paying user, continues to be best in class in the industry, rising from $16.70 in 2021 to $23 today. During this same time period, Bumble's and Match's ARPU has not grown at nearly the same level of CAGR. So for Grindr, that's a 10% CAGR from 2021 to today. Is very, very impressive. And I think that's only going to increase over time, especially as they roll out new products such as Roam, which allows Grindr users to sort of pin their location. Let's say you're going to Spain and you're in California right now. You can sort of pin your avatar or your user as being in Spain for whatever the dates are, and you can already start making connections with people who are there so that by the time you get there, you're ready to go, if you will. There are also AI Wingman is a new product that they're focusing on, where with permission, Grindr, AI will go through and it'll read all the chat logs that you've sent and it'll read all of the chat logs that your potential match has sent. And that includes with other matches as well, and it will gather a composite profile of what each user likes, dislikes, and where the synergies may be between two given matches, and it'll suggest where you should go for dinner, what you should do, how you should converse, what this person is into, using AI to better predict and match relationships with user consent. That is very powerful too, and the tailwinds of that are yet to be seen. That product is still taking a lot of upfront capital, but we haven't seen the returns just yet. And then also, they just launched a new product, sort of a seed stage startup last quarter. They've launched Woodwork, which is a true, quote, 0 to 1 effort equivalent to a seed stage startup just within Grindr. It is operationally structured to deliberately not distract us from our aggressive core product roadmap, which is where the overwhelming majority of our team is focused. End quote. So what this is a men's health subscription service built by gay people for gay people. So you can think of it as a hims and hers for selling erectile dysfunction pills and anything that the gay community really needs. And that's going to be embedded right within Grindr. Once again, making everything available in almost like a super app in one place, and then having a lot of different products, great UI, and a great customer experience is where Grindr is going with this. And so we think it's very compelling. We own shares. We've owned shares for a while. We did take some off the top at $23. Full disclosure there. And yeah, I mean, I don't know. I think in time we'll have to see how it pans out and see if it's really as monetizable as they say it is. But it certainly has been so far to date. And we were very fortunate to get in early on the journey. So now it's just we're waiting and we're going to see what the company does. I have a lot of conviction in George Arison, the CEO of Grindr. He's a gay man, has a lot of experience in building tech companies, and Grindr has delivered phenomenally over the past couple of years. So that is today's stock of the week. Of course, that is not financial advice, but hopefully it makes you think a little bit deeper about Grindr, maybe shifting away from just laughing at the stock to actually considering what they're accomplishing. Now it's time for the Retail Mailbox, when we answer our listeners' questions. This week's question comes from Megan, who asks, "Tell me about a time you got a stock wrong. What did you do about it, and what would you do differently?" Well, this is a really great question, and in short, I guess I've had a lot of stocks that have been wrong. The one I'm going to focus on today, because I do want to put out some more public clarity on it, is Krispy Kreme. This is a name that was very bullish on, and we owned it in Mapletree Capital for a while. And really the large reason that I was bullish is because Krispy Kreme has an extraordinarily strong brand. Everybody knows who they are, but they were really predominantly located in the southern part of the United States, and they just signed a deal to be in McDonald's for breakfast nationwide. And so I thought that this partnership would really expand Krispy Kreme's national presence. It would make it so their brand recognition is much stronger. And I thought the unit economics of the McDonald's deal would also provide some favorable top line and bottom line benefits to Krispy Kreme as well. So that was sort of a very quick way of sharing what my thesis was on Krispy Kreme. And slowly but surely, over time, ever since I bought the stock, the share price trended down, and the optimism around the McDonald's deal waned, and it quite significantly. And I held the stock way too long in these fears. I did not have as much confidence in the management team as I would have thought that I would like to have had. And I think over time, the story got worse slowly but surely, but it was getting worse. And management seemed a little unprepared on the conference call, while still dangling the nugget of, hey, we're going to be in McDonald's, by the end of the year, all these stores, and that's going to be a huge benefit to our business. That was what the nugget that they were dangling in front of, or the carrot in front of our noses, while the rest of the business struggled a little bit. Now, we expected the business to struggle, right, with Ozempic and GLP-1 fears and a little bit of pullback in discretionary spending from consumers, but starting to see that might just be a Krispy Kreme problem more than it is, just a broad decline in consumption problem overall. And so, sold the stock recently, earlier this quarter, following their earnings report, when it was just so bad that couldn't hold on any longer. I don't think that they're very good capital allocators. The balance sheet continues to not improve, despite posting some profitable quarters, in which I think they should be using the profits to pay down their debt. And they're not. They're not. And really, if you look at Krispy Kreme, it seems to be a bloated cost structure, which I thought the McDonald's deal would lower, but that's not the case. Krispy Kreme, that is, wants a strong grasp over their logistics, their shipping, and their handling of transporting the donuts. And I think it would be just so much easier for them if they would outsource that. I think their margins would improve. And that's why I was hopeful that the McDonald's deal would maybe bring that revelation to them. But it doesn't seem the case. So, we sold following the recent quarter for a monster loss of over 60%. Yet, despite that, when we sold, the shares have fallen another 25% from our exit point. So there is some, there's some goodness in selling a little bit early, although the loss is totally unacceptable. And so I think the lessons that I've learned from holding Krispy Kreme is that while yes, management can say that something is coming, sort of what I've been doing with Upstart, right? Like, it needs to be independently validated. You have to have trust in management, and they have to be showing tangible progress towards achieving that goal every quarter. And if you start to get the sense that, hey, like, I'm not entirely sure that management is doing this correctly, or that they're going to be able to pull that off, instead of just ignoring that and giving them more time, it's probably time to let go. And I can say I had that feeling several times with Krispy Kreme, like, well, it's probably time to let go. And I didn't. And eventually I did. And, people say when you sell a losing stock, you just feel so much better. I do feel a lot better. And, we actually reallocated that capital from the Krispy Kreme sale into NBIS, Nebius, which is up about 70% from our purchase, which, has sort of negated some of the losses that we saw with Krispy Kreme. But so that's sort of what we did about it, watching from the sidelines now. And true, I didn't even mention this. They actually, following our sale, and just like 2 weeks ago maybe, they actually terminated the McDonald's deal in full, which is why the share price went down even further. So just a total disaster. Another mistake that we made on that one was buying. Personally, I don't believe in DCAing. If I like a stock, I think it's at a fair price, I lump sum and then I react later. Just the time at which I bought it was not great. I bought it the day that the headline of the McDonald's deal came out. So probably didn't do enough research. Probably didn't examine the balance sheet, enough to understand that the debt problem was as bad as it was. So just, it was a move we made a little bit earlier in our fund, and it's just inexperienced, and I wouldn't do it again. And if I was going to do something like that again, I would definitely have more caution, and if my validation process wasn't going as well, I would cut the stock a lot sooner. And so the lesson for people listening is, if you have a bad feeling about a stock, just cut it. Just cut it. There are a lot more stocks out there. And management, they can be high promisers. They can say they're going to do all these different things, but at the end of the day, if you're not seeing it in the results, it's time to let go. So that's probably the biggest example of a stock that I've got wrong recently. Has had a huge impact on the Heartwood returns. Something that we're trying to fix as we go into 2025 now and 2026 next year, and I think it's going to be a very large headwind to try and negate that poor performance, and it's bogged down the fund, similar to the likes of the Chegg mistake that I made last year, if anybody remembers that from reading the Maple Tree Capital shareholder letters. But yeah, no, two big mistakes in Chegg and Krispy Kreme have bogged down on the fund's portfolio, and both were very similar stories of high promise, under-deliver by management, and just knowing that I should probably cut the stock earlier, and I've been trying to work on that. The problem is when you invest in misunderstood companies that you believe have some sort of disconnect between price, narrative, and what the business can actually do. Well, as the share price falls, you're naturally inclined to purchase more because you think that gap is widening. But I need to get better at understanding when the gap is not widening, but that my thesis is actually waning. It's a very hard distinction to do. It's something I'm working on. I think I will get better at it over time. And yeah, Krispy Kreme and Chegg have just been two very poor examples of my risk management in that regard. Now, I did sell Chegg for a loss at about like $7 or $8 a share, and it's fallen another 80% to $1.30. So that, that one was an example of me selling a little bit earlier than I did on Krispy Kreme. But yeah, it's just trying to wrap my head around not selling my winners, but trying to learn to sell my losers and then putting more of the money into the winners. The things you hear all the time, but it's a work in progress. And it's a learning curve, and hopefully we can get better at that over time. But this has been the Maple Tree Capital Podcast. I'm your host, Henry Invests on X. That's it for this week. Make sure to submit your questions to me at Henry Invests on X for the Retail Mailbox next week. Thank you for listening, everybody. Please make sure to give a like, subscribe, or if you're on Spotify, leave us a rating and maybe even a comment. And we will see you next week.